Here we go. 3, 2.
LeBron James. You know why everybody loves LeBron James? Not everybody, but most people. The reason why they love LeBron James so much because he is a diversified basketball player. He can shoot, he can rebound, he can assist, and he can play defense. Because he's so diversified, people love him. What's going on, guys? This is Min Win with What's a Mortgage. Welcome to our channel. The goal of our channel is to simplify home ownership. And tonight, we're going to talk about the most popular loan program, conventional mortgage. How to buy a home in 2022 with a conventional mortgage. It's the most diversified mortgage program out there. If it's your first time tuning in, do me a huge favor, hit the subscribe or notification button so you're notified every time we go live or post new content. We go live every Monday night on Facebook and YouTube at 9 p.m., Tuesday night on Instagram, and we post content daily on Instagram and TikTok. So if you're not following us by now, please go ahead and follow us on all our other channels as well. Also, guys, this is an interactive live stream. So if you have mortgage questions, we have mortgage answers. I'll make sure at the end of our live, if you have questions, please ask. Some of you guys saw my post over the weekend regarding mortgage payments. So if there's some conventional mortgage payments that you want to see at the end of our live, please go ahead and leave me the purchase price, the middle credit score, and then leave me the county you are, a state and county you are buying in, and we'll throw some numbers up here for you. Okay, we're gonna use a techie lender calculator by popular demand. I couldn't do them all over the weekend, so I'm gonna do some today for you. Right, guys? Hopefully you have a great night. Hi, Dad. Hi, Alex. How are you guys doing? So, why should you buy with a conventional loan in 2022? Here's the reason why most people are buying with a conventional loan in 2022. Go put the slide here. Okay, so here's some few reasons. Here are some few reasons people are buying with a conventional loan in 2022. You can go as low as 3% down. So FHA is 3.5% down. Conventional, you can go as low as 3% down as a first-time home buyer. As long as you haven't owned a home in the past 3 years, you can buy with a conventional loan 3% down. With conventional loan, you can buy owner-occupied, second home, and investment property. Also with conventional, it's easier to upgrade. So if you own a home, you bought it over a year ago, it wasn't the right fit, or you decided you're going to turn into a landlord, you can rent out your property and buy your new one with conventional. It's a lot easier than buying with FHA because of the 100-mile rule. Conventional loan doesn't have the 100-mile rule. Also, another reason why people buy with a conventional loan, cheaper and more and flexible PMI. So of course, if you have good credit, conventional PMI is a lot cheaper. Also, there's different types of PMI. A lot of you guys talk to lenders that say, well, this lender says there's no monthly PMI, because they do something called lender paid MI. So there's lender paid MI, single premium MI, which means you pay all the MI all up front, which means you don't have to worry about refinancing or rates going up and down. You do one-time pay and it's done. There's monthly, and then there's split, which means you can pay some upfront and some monthly. That's why a lot of people who have good credit, they're rewarded with a conventional loan that gives them flexible and cheaper PMI. Also, the reason why a lot of people go conventional, they don't know where rates are going to be. They don't want to refinance from FHA to conventional. Of course, if you're not in a good position, you got to go FHA. Well, let me wait till my credit gets better, go conventional. Rates might go up. A lot of people that did wait to go FHA to conventional, now their payment is higher now, and they should have bought FHA. But if you are in a position to go conventional, your PMI falls off automatically, which means you don't have to trip over refinancing again. You don't have to pay the $5,000-$6,000, eat up your equity to refinance from FHA to conventional. Also, conventional, higher loan amounts than FHA. Google your county, your FHA loan limits, and your conventional loan limits. You'll notice conventional loans have higher loan limits. Okay? So that's the reason why a lot of people have a better chance to go conventional when they fall into these categories. Of course, if you don't fall into these categories, you can still go conventional, but these 5 are probably the main categories, to when to go conventional, right? So before we decide to go with a conventional loan, do me a huge favor. If you want to begin the process of home ownership It starts with step 1. Okay? Download our Ultimate Mortgage Guide. In our Ultimate Mortgage Guide, we give you everything you need to know about all loan programs: FHA, VA, USDA. Doesn't matter what program you're qualifying for in the United States. If you understand the foundations of how to qualify, you can qualify for any program. Also, if you want to hear the guide, there is a YouTube playlist. We try to make it as accurate and congruent as possible to the Ultimate Mortgage Guide. So that is the first step on buying with a conventional loan. You want to make sure that you have the tools in front of you. Right now, I'm learning how to trade options. The best thing for me is I have my guide in front of me and I watch the YouTube channel, right? Anyone ever read Rich Dad, Poor Dad? I'm listening to the audio, but if I didn't have the book to reference what he's talking about regarding the numbers, I would be lost. So if you guys are thinking about reading Rich Dad, Poor Dad, definitely download the guide or buy the audiobook with the guide. But if you are reading it, you will see the references and the figures in the book. That's why I would definitely do that. So same thing with our Ultimate Mortgage Guide. You want to make sure you have all your references in front of you when you're watching these videos, so you are empowered on how to buy, especially with a conventional loan. So step 1, download everything. All right. Next step, step 2, solidifying your income. If you're going to buy with a conventional loan in 2022, you want to make sure you collect your last pay stubs from 2021 if you're a wage earner. Why? Because you want to break down your overtime or bonus. If you had a new pay raise, they're going to see that in your pay stub. Makes it easier for a lender to get you a solid approval. Even if you're buying in June, April, and of 2022 with that pay stub, a lot of times a lender doesn't have to order a VOE. It all depends on how they qualify you, but it helps them understand where are you at financially. If you're self-employed, here's the difference, right? You want to have your lender review your draft tax returns. You might not want to write off everything if you're trying to buy in 2022. It's important, especially if you are thinking about going owner occupied. Here it is. Here's a little nugget for you guys. If you are self-employed and you write off everything and you have not filed 2021 yet, if your business has been around 5 years or longer, or you've been self-employed 5 years or longer, that means you don't have to own the same business for 5 years, but you've been self-employed for 5 years, they'll go off of 1-year tax returns. So if you have to pay the IRS, right, with a conventional loan, you can set up payments. Remember, grind down the monthly payments on that IRS payment. But you can go 1 year self-employed. So if you have to show income to buy, you are going to owe. But this is the way for a lender to look at it, because they have to add that monthly payment of your what you owe on your DTI as well. So if you haven't filed your tax returns the last couple of years and you want to buy in 2022, make sure you want to solidify your self-employed income. Have a lender review your draft tax returns before you turn it into the IRS. Of course, if you have non-taxable income, remember, with a conventional loan, you can gross it up 25%. For example, if you're collecting $2,500 a month, 25% of that would be $625, which would make it $3,125, which is a little higher than on FHA. FHA was 15%. This is 25%. Any non-taxable income, you can gross it up. If you are using Social Security income, okay, you can use your new reward letter. You don't have to take an average. Anything that's a fixed income, you can use the most recent one. There's no averaging it out. Remember, if it's non-taxable, you can gross it up. So step 1, download the guide. Step 2, solidify that income. You want to make sure it's easy to buy with a conventional loan in 2022 by solidifying the income. Have the documents ready if you're looking for an accurate pre-approval. You want to know where you stand in case you need to pay down some debt, drop the purchase price, increase the down payment, or add a co-signer, okay? So once you solidify step 2 by gathering your income, you want to validate that credit, right? If you're not ready to buy, it doesn't matter if a lender runs it or not, right? You want to make sure you look at the debts. If you validate your own credit, make sure if you run your own free credit, it's not a hard inquiry, so it does not affect your credit score. A hard inquiry is when a lender runs an official credit score, and that does affect your credit, okay? So once you download the guide, once you validate your income, next step is validate your credit. You want to run your credit yourself. If you're ready to buy, let a lender run it. If you ran your credit, Conventional different than FHA. If you're not sitting on a 700 when you run your own credit, most likely you're going to be under the conventional guidelines once a lender runs it. So if you run it yourself, you're above 700, you're solid. When you're in the high 6s, 700s, you might want a lender to run it so you see where you're at if you want to go conventional. Remember, we want to break apart your credit. You want to separate the balance from the monthly payments. Why is that? You might need to pay off some debt, right? You want to pay off the biggest monthly payment with the lowest balance to increase your buying power. Remember, for every $350 a month you eliminate, that's $50,000 more home. Okay, so once you validate your credit, you check the balance, the monthly payments, you check the score, make sure you're above 700. Then you want to add your court order debts. If you're looking on your credit report, you don't see your court order debts. What are court order debts? Child support, alimony. If you lost a lawsuit and none of that's on your credit, you want to add that monthly payment. Same thing with government order debt. If you owe money to the IRS, if you owe money to the IRS, sorry about that, I need some water. You want to make sure you add those monthly payments if it's not on your credit report. The lender will find it. But here's the trick. If you owe money to the IRS and you've been making your payments on time, you didn't let it go delinquent, those payments will not show up. But if you let your IRS payments go delinquent, now it's on your credit, the lender will see it. Or if it gets garnished for your pay stubs, the lender will see it and have to add that to your DTI. Okay? So once you tally up the monthly liabilities, now you're painting a better picture for a lender to see, can you go conventional? Is your DTI too high? If your DTI is too high, you might have to go FHA. Okay, not saying that's a bad thing, but you might have to go FHA. I see a lot of people, they think everything is solid. They don't let a lender review everything. They don't prepare everything up front, and now they have to go FHA or they have to pay down debt. And now that house they want to buy, they lost an opportunity because they're chasing that conventional loan because of the flexibility it gives you, but now you can't. Okay, so you want to make sure you download the guide, you validate the income, and you validate the debts. Okay, make sure you don't include utility bills, cell phone bills, credit card. You know what's crazy to me? And I understand why I'm getting toasted. I'm getting roasted right now because I put some payments online. Well, there's no way someone can afford that because they can't live. Yes, I do agree. Banks, they have not got to this yet. You know, in DTI, it doesn't include gas. And you know what shot up over 50%? Gas. So yes, with gas going up, you might not want to teeter at the max DTI, all right? Even though it's not included, I would think about it, okay? So once you validate that information on your credit, next part of your credit, you want to validate the public records. If you want to go conventional, you want to make sure after 4 years after chapter 7 or 11, 2 years after chapter 13, 4 years after a short sale, 7 years after a foreclosure, and 2 years after being repossessed, if you had something repoed. So you fall under the categories, you might have to go FHA. So that's why I do challenge you to validate your credit yourself. Remember, it's not a hard inquiry. You want to see your balance, you want to see the monthly payments on it, and you want to see your public records. You want to make sure that you don't fall under these categories. Like you had a BK, you don't know exactly when it got discharged. You want to check your own credit. Okay. Also, another important thing about checking your credit, you want to see what debts you can omit. Conventional, a lot more flexible than FHA. Okay. With student loans, if there's a monthly payment, whatever the monthly payment is when they run your credit, that payment is added to your DTI. If you're paying no payments and you're in forbearance or deferment, you take the balance times it by 0.5%. For example, if you owe $30,000 in student loan, it's $150 a month. You owe $60,000 in student loans, it's $300 a month. If you owe $100,000 in student loan, that's $500 a month. They add to your DTI. Remember, every $350 a month is about $50,000 more home. Next one, if you have a student loan and it's in income-based repayment, when they run credit, whatever the payment is on your credit report, they add that to your DTI. But check this out. If your student loan income-based repayment is 0, they add 0 to your DTI. So if you have student loans and an income-based repayment says 0, there's nothing to add. You don't have to times by 0.5%. How amazing is that on a conventional loan? FHA, that law just passed, but on conventional, it's been around. But here where it gets good. So if you have a car payment, not a car lease, a car purchase with less than 10 payments left, or any installment debt, which means there's an end date to it. If there's less than 10 payments left on a conventional, you can omit the payment. With FHA, it has to be less than 10 months and the payment has to be less than 5% of your gross income. With conventional, it doesn't matter as long as it's not a car lease. It still has to be an installment debt. Tax liens, a lot better than tax liens, a lot better than FHA. FHA, you have to show 3 payments. On conventional, as long as you have a payment letter, that payment letter is added to your DTI and boom, you're good to go. Co-signing, a lot better than FHA as well. And a lot of you guys run into this. If you co-sign for somebody, you just need proof of 12 months that they're making the payments and you could omit the debt. On FHA, you have to be the co-signer on the debt on top of the 12 months. So if it's a home and you're on it and the other person's not on it, you can't omit it. The other person has to be on title, okay? But look at car loans. If you're the if you're the main and they're the co, even with 12 months canceled checks, you cannot omit it. You have to be the co-signer. You can't be the main on FHA. But on conventional, you just need proof of 12 months and you can omit the payment. See where you get that flexibility with conventional? Why so many people go conventional. If you have good credit, you are rewarded with more flexibility, right? So once you figure out the credit, you downloaded the guide, you validated the income, you validated the credit, right? You looked at all the balances, you looked at the public records, you find out what debts you can omit to give you more buying power. The next step is the DTI cheat sheet. You want to make sure you put it all together. You want to budget your DTI. You take, if you're a wage earner, a 2-year average of your overtime or bonus or commission. If you have a base, you can take the newest base, just average that out. If you are self-employed, there's a little typo on here. It's my fault. 1-year tax returns, not a 2-year average. You can go for 1-year tax returns if you're self-employed. Remember, take your income, times it by 45%. A lot of you guys think that's aggressive. If you think that's aggressive, times it by 40%. Here's an example. If you make $10,000 a month, times it by 45%, that's $4,500. Let's say you have $1,500 a month in bills. That means your max mortgage payment is $3,000. Let's say 45% DTI is too high, times it by 40%. That would give you $4,000. If you have $1,500 in debt, then of course you would qualify for up to $2,500. If you're not happy with a $2,500 mortgage payment, that's where you start paying down debt. That's why it's important that you run the credit and you separate the debts from the balance, because what can you eliminate to get that monthly payment up? Once you have all that figured out, here's your DTI cheat sheet one more time for those of you who think 45% is too aggressive. There's even 50%. Conventional loan, they reward good credit. They let you go up to 50% DTI on the household debt and the complete debt. FHA is 45 over 50, or 55. Conventional, it's 50 over 50, but I wouldn't take it to the limit unless you plan on eating top ramen and you don't want to eat filet mignon, right? Or impossible meat for some of you guys out there who don't eat meat, right? You can take, don't be aggressive on your household debt. So I did a little breakdown. If your income is in that area, you can kind of eyeball it, or like I said, take your gross, your 2-year average on W-2, set for your salary, and then a 1-year self-employed, if you've been self-employed for over 5 years, times by either 40, 43, 45, or 50. Those are the average DTI out there. Once you do that, then you want to see what can you buy. So pick an area that you want to buy in. If you're going to go with a conventional loan, there's some purchase prices for you on 3% down. For 3% down, it must be owner occupied. 3% down, owner occupied, and you can't own a home for the past 3 years. First-time home buyer. If you're buying owner occupied and you're not a first-time home buyer, or you just want to go in with a bigger down payment to have a cheaper PMI, there's the 5% down. There's 10% down. If you are buying a second home, a vacation home, that conventional gives you that diversity. 10% down. 15% down if you're buying a duplex. 20% down if you're buying an investment property. 25% if you are going Fannie Mae 3-unit or 4-unit. So those are some down payments. So you can decide, hey, do I have this money to go conventional? Or how long will it take for me to save enough to go conventional. Now that you figured out what your budget is, what the down payment is, here's another tidbit for you, the down payment matrix. If you're going with a Fannie Mae loan, sorry, I forgot another N in here, it's FANNIE, my bad, on the Fannie Mae. Purchasing 1 unit, 97 or 95% LT loan to value. 2 unit, 15% down. This is owner occupied. 3 to 4 unit, 25% down on Fannie Mae. This is for your principal property. Second home, 10% down. Investment property, 15% down, like I said earlier. 2 unit to 4 unit, 25% down on an investment property if you want to go with a Fannie Mae loan. Look at Freddie Mac. That's another thing. Conventional has Fannie Mae and Freddie Mac. FHA just has Ginnie Mae. So only one guideline. Look at Freddie Mac, 5% down. 2 unit, 15% down. For all those investors, look at Freddie Mac's 3 unit to 4 unit, 20% down. When Fannie Mae is 25% down, that saves you 5% right there. Second home the same, 1 unit investments the same, 2 to 4 unit the same for investment, but owner occupied, 20% down. When you're going Fannie Mae, you're doing 25% down for 3 unit or 4 unit. Saves you 5% right there. Gives you a lot more flexibility. So now that we know how much you need to save, how much you need to put down, the next step is make sure your money's right. If you are drawing from your retirement on conventionals, pretty black and white. If you're drawing from a retirement that's been pre-taxed compared to post-tax, if it hasn't been taxed, you can draw as a loan or hardship. If it's already been taxed, like in a Roth IRA, after 5 years, you can draw the principal out, whatever you've put into it. If you're getting money as a gift, conventional, a lot different than FHA. You can wire the money directly to escrow, and they're not going to ask for the donor bank statement. There we go again with that flexibility. With FHA, even though the donor wires it, you got to prove that the donor has the ability to gift. You don't have to do that in conventional. Conventional also has a one-time non-payroll deposit. You don't have to source, as long as that deposit is 50% of your gross income. So if you make $5,000 a month, you're allowed one deposit for $2,500 that you don't have to source. This is a Fannie Freddie Direct. So if your lender sells this loan to an investor, they might have that overlay, which a lot of them do. But if they sell to Fannie and Freddie Direct, you're allowed a one-time random deposit for 50% of your gross income in the last 2 months of your bank statement. Now, if you're sourcing equity, remember, cash out. If you cash out on a home to go conventional again, you got to wait 12 months. It says so in the guidelines. HELOC. You get a home equity line of credit to go conventional. You can. When you get that HELOC, depending on who you get the HELOC from, some want you to wait 12 months, some of them don't care. Conventional, when you sell your house to buy a house, make sure you complete that seller's net sheet. You want to see what you net. Some people think, especially if you bought a home in the last year, 2 years, when you sell your house, there's real estate commission. Make sure there's enough equity for you to put down to go conventional. Gift of equity. Make sure you know how much the seller wants for equity if you don't have to give them anything at all. So make sure you know you prepare your equity correctly. Talk to a lender, get approved, depending on the program. Look at if you're selling a property and you're buying investment, 1031 exchange, or however you're buying your next property, you want to prepare your equity correctly on a conventional loan. Since down payments are bigger than FHA, you want to make sure you cover your closing costs from selling the house, the real estate commission, that you have enough to cover down payment and closing costs on your conventional loan. So once you download the guide, you validate your income, you validated your credit, you put it all together, your DTI, your down payment. Yeah, I did that already. So step 6 is you put your payments together. And we'll go over that in a second. If there is a payment you want to go through, we are going to do that tonight, all right? So we're going to put the payments together. And then you got to see, are you happy with the payment? With everything you put together. Step 7, you rebalance. You might need to drop the purchase price. I know a lot of you guys don't like to do that. You might need to bring in a bigger down payment or pay off debt or add a cosigner. Or, which a lot of you guys don't want to do, which a lot of you guys need to start accepting, not all, you might need to move. If you can't save a big enough down payment to afford what you want, or you can't get to the payment that you want and be happy. If you don't love the payment, don't love the house, you might need to consider moving. I know it's a shocker to some of you guys, but that's where we're at right now on where prices are at on homes. Not for everybody. But some guys, well, then I don't want to own a home. It's okay. You don't have to buy a home. But you should do all this homework up front. So when you do come time to buy a home, you can either decide I can buy or I'm just going to rent for a while and I'm cool with that. So those are the 7 steps to buy with a conventional loan and how to buy with a conventional loan. It gives you the flexibility to buy with a conventional loan in 2022. Here's a little secret here. Shh. The secret of home style and kitty condos with a conventional loan. So here's a trick. On a conventional loan, you put 3 to 5% down. You can do a renovation loan. Depending on the lender, they will loan you between 95 to 110% of the new appraised value, right? So you can do that. If you know how to do your construction right, and you can get the home to have a certain value, but you don't need to use up all that equity to get there, maybe you can remove PMI. Wow. Crazy, huh? Think about it. If you bought a home, FHA or conventional, you can do a home style refinance. Remember, they'll loan you up to 95 to 110% of the new appraised value. Let's say you add let's say a lot of you guys gain a ton of value and you want to get rid of PMI. You can update your kitchen, update your bathroom, make some renovations to it. Now you can use the new appraised value and you might not even have PMI. So you were able to do the renovation and you were able to use the new value and you don't have PMI. There's strategies to do it. Make sure you talk to a lender to find out what LTV you need to be at. Make sure you talk to a couple people, contractors, to make sure what upgrades can I make to put my property out of position. Or some guys might have tons of equity already. You bought in the last 2 years, you have tons of equity, but you're not in a position where the PMI falls off automatically. Renovation is a strategy for it to fall off, and you get to renovate your property. You can add an ADU, turn that single family home into a duplex if you want. And now next, the kitty condo. Just like FHA, you can buy a home for one of your children to go to school, and you can go 5% down. Here's another way to buy, not an investment, another property. Because your child can go to school, buy 5% down. You can't use border rent to qualify. You're going to have to qualify for yourself, but legally, you can still rent out the other rooms, and you can keep the money on a kitty condo. It doesn't have to be a condo. Or you can buy it for an elderly parent or parent-in-law or a grandparent and use the kitty condo rule. 5% down. You got to qualify for all the payments. Let's say you buy for your elderly family member and they have income, they just don't have enough to qualify. You can buy 5% down. So your child or your elder has to have credit because they're going to be the main borrower on the loan and you're going to be the co. Let's say you don't have enough to qualify. You can add any relative to help you get that DTI down till you're at a place to remove the DTI. And that's how you buy another property with just 5% down. Say with me, 5% down. Kitty condo, home style. There's all these strategies you can do to increase value. Turn your property into an asset, not just a liability. Remove PMI. All right? So there is a lot you can do with conventional. And there's a lot you can do right now. And what you need to do right now is follow us. Follow us on Facebook, YouTube, Instagram, and TikTok. All right, link to what? I didn't. Oh, one last thing, guys. I did skip other things you want to remember on conventional loan. My bad. Other things you want to remember besides follow on my page, follow all my stuff.
Tell them to comment no questions for Q&A.
If you have questions for Q&A, please comment below. I'm about to do some numbers here. If you have a purchase price you want to go over, let's do it on conventional. Okay, I need purchase price, middle credit score, and kind of the area that you're looking to buy in. Okay, like give me the state and city. If you're in California, then I can look up some numbers. Okay, outside, just give me the state. Remember on conventional loan, if you buy your first property as a rental, not a owner occupied, you cannot use the rental income if you don't own a property. You can't use the rental income to help you qualify if the first property you buy is a investment property and you don't own a home. That's a thing to remember on conventional. Also, when you buy a second home, 10% down on that second home, it has to be in a vacation destiny area. You can't say I'm buying a vacation home in Needles. They'll give you the needle for that, all right? So no needles. First-time home buyer, 3% down. You can't own a home for 3 years. If you've had to own a home in the past or you're upgrading into another owner-occupied, you got to go 5% down. Also remember with conventional, PMI falls off. Once you pay down the house, 20% of the original purchase price without refinancing, okay? If you pay down 25%, if you have 25% equity, after 2 years, you can get an appraisal done and remove your PMI. Yes, there are some servicers, they're allowing you to remove it after a year and a half on a conventional because equity shot up the last 2 years. But it's kind of, slow down on it to the trajectory of appreciation right now. That might not happen again. So the rule is 2 years. It's on your loan docs. If you're self-employed, remember, you can go 1 year tax returns as long as you've been self-employed for 5 years or longer or own a business for 5 years or longer. 700 credit score, at least 5% down for all you self-employed people who wrote off everything. Trust me, I do the same. The year you want to buy, you will owe taxes. Just grind that payment down if you don't want to pay all at one time. So, and that monthly payment's added to your DTI. So be careful if you go 1 year self-employed and you haven't shown income for years. Be very, very careful, okay? On conventional loans, here's a good thing. If you put 20% down or more, you don't have to have your account impounded, which means your payment doesn't include tax insurance. In California, it's 10% down or more. You don't have to impound your account. So those are a couple things you need to remember when you are going conventional. And remember, follow us on all our channels, right? Facebook, YouTube, Instagram, TikTok, LinkedIn, What's a Mortgage? Guys, if I brought you value tonight, do me a huge favor. Save this video, share this video, and like this video. All right? So if you have mortgage questions tonight, let's do this, okay? So if you have mortgage questions, I have mortgage answers. A lot of you guys want to go through payment. Let's bang out these payments here, okay?
And if you don't get to their question tonight,
and if I don't get to your question tonight, or if I don't do your payment, always give us a call, 714-790-9697, or message us. If you have a loan estimate you want us to review, help you read it or beat it, email us, info@whatsamortgage.com, and we will be reviewing your loan estimates. All right, guys? Let's get some Q&A here. Let me scroll up. Ready?
there you go. Okay, take it.
All right, ready? Let's go some Q&A here. Hi, Dad. What up, Alex? How you doing? What is lender paid PMI? Budasag. How good a credit is, sir? If you want to go conventional, I recommend it's a 700 credit score or higher. If you're going investment or second home, you have no other options, 680. Even though they let you go down to 620, it won't even pass DU. So 680 or higher, but if you're going to go owner occupied and you want to maximize the best payment, FHA is cheaper under 700 credit score. 700 credit score and up, conventional is cheaper payment because the PMI is cheaper. Okay, Budasa. Alex, lender paid MI is when you take a higher rate and the lender pays your mortgage insurance for you. If you make over 109 grand a year, I like lender paid MI, even though the payment might be like $20 higher than with monthly. But check this out. Monthly MI is not tax deductible after 2021. They have not announced it for 2022. But mortgage interest is tax deductible. So lender paid PMI is not that bad. All right. What up, Keys? New job. If you got a new job, what's the new job, Keys? Zephy, hi, man. If we use conventional, can we drop PMI without refinancing and the house has enough equity after the first year of paying the mortgage? You can call your servicers, Zephy. Some servicers might do it before 2 years, but most servicers want you to have 25% equity after the first 2 years, and then you can do it. All right, Zephy? Hopefully that helps you out. Hi, Mom. How you doing? Jukmung Namay. It's almost New Year's. If you're Asian out there, Happy New Year's coming up. Maybe a little too early, but, I'd rather be early than be late. Why do they include your school loans on DTI if they don't need to be paid until May 2022? Because when the payment comes up, they have to add that payment to the DTI, MJ. What happens if you were loaning out money to somebody, MJM, and in May, another payment's going to pop up? Would you want to loan them that money in case they can get around it? No, you wouldn't. You would want to loan them the money based on risk that there is going to be a student loan payment. That's the reason why. All right. Hopefully that helps you out. Tyler Ho. My sister lives with me but wants to purchase a rental home. Can she get a conventional? She makes $100K and $700,000 purchase price in Monterey County. What's the lowest down payment? So your sister would have to go, if she's going to live with you, investment 15% down. If you want to buy a second home, that's going to be 10% down. Monterey is a place where you can probably get away with a second home. But remember, they're going to hit her on that second home and the rent, whatever she's helping you with rent on. All right? Hopefully that helps you out. So 10 to 15% down. John Anthony, yep, quick tip. The IRS will only allow what you owe to be paid in 65 years payments, and all depreciation can be added back into the income. Yes, that is correct. Can you gross up income with VA loan? If with VA, you can gross it up. If it's not a taxable income, you can gross it up. You can gross it up 25% as well, just like conventional. Okay? Hope that helps you out. Hector, fixed income. Social Security income is fixed. If you get child support or alimony, you're receiving it and it's non-taxable, you can gross that up. Yvonne, what's going on? Casey, what's going on? Jolene, how you doing? You're so knowledgeable. Thanks so much. You're welcome, MJM. Cecia, how old does a parent need to be to qualify for an elderly parent? That I don't know exact guideline, but I'm guessing elderly something over 62. All right. Boderm, 590 home price. Let me answer this question. I'll do Boderm. Chismina, I own a primary resident in California and just bought a second home in Florida last year. Currently renting my second home now. Both homes are conventional. What's the qualification to buy another property? Can I use rental income to qualify? If you bought a rental property last year, they're going to go off your deposits. If you've had it for over a couple years, they're going to go off your tax returns. As long as you're showing income on your tax returns on your rental, you can use it. If you have a property, you're going to turn into a rental and buy the next one owner occupied, you can use 75% of the rental income. Hopefully that helps you out. All right, Boaderm. Let's go here. Techie lender. Let's pop it up.
Let me take the mouse.
Mm-hmm.
Let me fix the camera.
1 second here, guys. We're going to try to increase the size of this so a little more legible for you.
Let me fix the camera.
1 second, guys. One second here while it's getting fixed.
Okay, we're just gonna do you on the side. So
Yeah. Is it big enough or can we make it bigger?
Oh, let me zoom in.
Yeah, zoom it in. Here we go. Zoom it back out.
Take the mouse.
All right, ready here? Here we go. 590. We're looking at 590 here. Single family home. At 590, I'd go with 5% down. I need that middle credit score. Let's assume you have a 740. With a 740 credit score, you're looking at 590 purchase price, 5% down, rates 3.75, APR is 3.925, total out of pocket 41,000.
Wait.
Dude, it's too late. I gotta keep going. I gotta keep going to the next one, dude. I can't.
No, her information's here though.
Okay, where's she at? 590, 10% down. All right, guys, I need you to make it a little bit easier for me here. All right, so Bodie, dang man, she got down to the T here. I gotta do everyone. Okay, 590. I gotta skip her then. Chang Sung Lee.
Let me fix the field. Get that ready.
All right, guys, give me 1 second here. Bill Durham, you gotta help me out here. I'm gonna do yours I'm gonna hook you up anyways. But man, you guys, I need to know the purchase price. If you know the tax rate, let me know the tax rate, the middle credit score, and how much you want to put down. Okay. Makes it easier for me. So let's go with Chang. Chang. So Chang is going to go 250. We're going to go with, right now we're going to go with, let's see here. 20% down. So Chang is buying $250 purchase price, 20% down, 4.75 total out of pocket, $57,500. Total mortgage payment is $1,353. Hopefully that helps you out, Chang. Bodie Derm, $590 purchase price. $10 down. What you got here? You got 699 credit score. 10% down. Tax rate of 1.81. $200 HOA. 10% down. That shouldn't change too much. So $590 purchase price, 10% down, $531 loan amount, rates 4 1/8, out of pocket $70,800. Monthly, oh, I forgot HOA here, $200. Your total mortgage payment is $39.31. Hopefully that helps you out. What's going on? Buddha saying, Janelle, is it worth saving 5% and waiting until end of the year to purchase a home with conventional loan versus 3.5% down? If you qualify right now, Janelle, buy right now. By the time you get 5% down and by the end of the year, prices will be up or payments will be up. If prices go down, rates will go up. As a lot of you guys see, prices are not going down and rates are still going up because there is a lack of inventory. There's less than a month worth of inventory. If today no one else put their home on the market for sale, in 30 days, we would be out of homes to buy. So think about that before you think, oh no, prices are going to come down because rates went up. Theoretically, that should happen. But right now, there's just not enough inventory. Buddha, 661, go FHA. 661, actually, I would go FHA for sure. Do you have the breakdown steps on math behind figuring out DTI to see where you stand? MJM, you take your monthly gross income, times it by 45%. If you want, you should download our Ultimate Mortgage Guide. The breakdown is in there. If you check out our Ultimate Mortgage Guide playlist, how to budget for your mortgage payment, everything you need on DTI is in our playlist and in our guide, all right? Hopefully that helps you out. Self-employed mortgage, conventional or FHA. Can I use my parent on the load to help proof of income? Yes. You can use them. You got to add their debt, but you can use them. So I would try to go conventional first. If you wrote off everything, you for sure need your parents. If you did not write off everything and you want to go 1 year self-employed, make sure you've been doing it for 5 years. All right. Hopefully that helps you out. My sister owns a condo that she wants to sell to me. I've never owned before. Currently renting. I already plan to buy a townhouse, but would a lender let me buy both at the same time? Not like that. If you buy, you can't buy simultaneously. If you do buy simultaneously, remember, if you buy a rental, you got to buy your owner occupied first so you can use rental income to buy your other property. On your rental, you're gonna need at least 15% down. Hopefully that helps you out. Cleopatra, how many years of tax returns does a lender need to see for first-time home buyer? If you're a wage earner, they don't have to see any. If you're self-employed, for under 5 years, they're gonna need to see 2 years. FHA, 2 years for sure. If you want to go conventional, if you'll be self-employed for longer than 5 years, then 1 year. How much you need for a down payment depending on the program. You can go ahead and in our guide, we have a down payment simulator for you so you can see how much you need for your down. All right. Aguila Dora, 380K, credit score 800, 10% down. Central Valley would like a payment of no more than 2,100 with no debts. New home construction. Let's go here, 380. See here, 380. Let's go payment, Andy.
Switch it.
So let's go 380 here. 380 purchase price. FICO score is 800, 10% down. What is the I'm sure you remember to add HOA if you're doing new construction. Because your FICO is going to be 0.29. Actually, point less, probably. Oh, 10% down, right? 0.19. So 380 purchase price, 10% down, raise 3.75. Your out of pocket is going to be about $50,000. Payment is going to be $22.83. $22.83. I have that $200 HOA in there. So if there's no HOA, which there is going to be one, then your money. If you remove the HOA, $2,083. Of course, there's HOA. Hopefully that helps you out there. Dora, Redland, 700 grand, 20% down. So Sasia, I need a credit score, Sasia. I'm gonna assume. Oh, seven. There you go. 762. 700 grand. 700,000. 760, right? Yeah. Okay. We'll make it easier for me. 10% down. How much are we doing put down here? Sasia. 20% down. Look at Sasia's a baller shot caller right now. 20% down.
Have the mouse for 2 seconds.
Okay.
Take it.
Okay. 20% down. That's 140 grand. Loan amount's 560. Right? 20% down. You don't have to worry about PMI. So for Sasia, 700 purchase price. 20% down is 560. Rates 3.75. APR 3.958. Total out of pocket 154,000. Principal interest con todos 3410. All right, hopefully that helps you out. Someone with SSI income can qualify as a co-borrower. Yes, you can. Hey, man, thank you for recommending Tony. He is out of town today, but I finally... Congratulations, concert dude. Thank you so much. Let me know if you need anything. Man, after looking and for months, how's it for showing? Awesome.
Can you switch it back to chat?
Why?
Because you're going.
No, I already have another question popping up. I'm just reading down the list.
Let me go back to
Eduardo, 200,000, 10% down. What's credit score here, guys? 720. Okay. 200 grand. Is it 200 grand? 760, right? Or 720? Okay. So 720? 720. All right. 720. 10% down. What's the down payment here? 10% down. 10% down. All right, here, let's look at PMI here really quick. So what's the FICO? 720, 10% down. 720, 10% down is going to be 0.46. 0.46. If there's 0.46, 0.39. Okay, 0.39. All right. $0.39. So $200,000 purchase, 10% down, 180. Rates 3.75, APR 4.029. 26 grand out of pocket. Total mortgage payment $1,150. 10% down. Hopefully that helps you out. Millennial Money. $750 purchase price. Okay, here we go. $750 purchase price. 10% down. Rate's the same. Tax rate, though, 1.36. Mortgage insurance, going to be 0.29 for sure. Wait, 10% down. Oh, 10% down, 795. Hold on, 795. 795, 10% down, 0.28. 0.28, 0.21, okay. So, $750 purchase price, 10% down, 3 3/4, APR 3.934, $90,000 out of pocket. Your payment $41.87. Hopefully that helps you out. San Antonio, 3% down. Ooh, San Antonio 660. I would go let's go FHA. So with Super Meek, I'm gonna go FHA with that, okay? Because the payment is gonna be no bueno on conventional. So 310. FHA. Texas rates are a little higher than California. Property tax is going to be 2.5. So if you go in Texas, 310 purchase price, 3.5% down, including closing costs, out of pocket $2,000 or $20,000. Your principal and interest payment $2,272. Hopefully that helps you out. Where did you find Cali no PMI if 10% down? You can do 10% down if you go with a jumbo loan, or there can be 10% down lender paid MI. Where did you find? There's a lot of banks that do no monthly PMI on 10% down. Tyler, what's going on? Thank you for the tip. I don't charge my sister rent. She doesn't have enough yet for 15% down. Can I co-sign? Yes. If you buy an investment home, you're probably buying it with her. So you would be a co-signer with her. You can do that. What's going on? I would set it up that you guys are buying it together, not you being a co-signer, okay? 703 credit score. Can I go conventional? Yes, you can. Make sure you go 5% down. If you go 3% down, payment's cheaper on FHA. Thank you so much. Hey, Mary. Cleopatra, can you repeat what you said about bills that are recurring and current? How many payments should be left for FHA? So, Cleopatra, if you have a mortgage payment, if you have debts, if it's revolving, you cannot omit it. It has to be an installment debt, which means it has an end date. If it's an installment debt with less than 10 payments left on a conventional loan, the payment has to be less than 5% of your income. So if you make $5,000 a month, that payment can't be more than $250. Hopefully that helps you out. I have a 750 score, 200,000 in Taft. What do you recommend down payment? I recommend you go 3% down. Okay, Danny, with that credit, 3% down for sure. You're welcome. I'm building an ADU on my property with all cash. Can I cash out refinance after the ADU is built? I currently have a loan for $400K. An ADU cost me about, and the ADU is built and will be valued at $800. Yes, you can do a cash out refinance after that if you want. Credit score 700, 10% down, 450. Thanks in advance, Jay. Because you said thanks in advance, Jay, I'm going to hook you up. Guys, if I did your numbers tonight, do me a huge favor. Save and share this video. Hook me up. I'm going to hook you up. 700K for our boy Jay right here. 700K. Oh, 700. What's the purchase price? No, it's 450K. 10% down. 700 credit score. 10% down. Like conventional. Forgot about that. Let's flip this thing conventional. What's it? 10% down, 700. 3.875 term 30-year fix. Down payment 10% down. Actually, 10% down. I give him this back. Hopefully that's California. So I'll do 1.25 for you. And 700 FICO, right? Let me see here. 700 FICO, 10% down. 700 FICO, 10% down. 0.55. 0.55. 0.55. What's 0.55 minus that? What's 0.48? 0.48. Okay. So, Jay, if you bought 450, right, with your 10% down, rates 3.75, APR 3.934, $54,000 out of pocket. Payments $2,562. All right, brother? Can I convert to conventional with what minimal credit score? If you go from FHA, Mary, you want to have at least a 680 or higher to convert it. I like 700s though. Cleopatra, are Zillow numbers trustworthy? My realtor despises Zillow for some reason. Yes, I don't trust Zillow's number. All right, guys. What's the difference between FHA and conventional? FHA, more flexible when it comes to credit and higher DTI. If you have good credit, going conventional is just a better deal overall. Okay? Don't forget to subscribe. Thank you, guys. Guys, hopefully you enjoyed tonight's content. Do me a huge favor. If you're not following me by now, please hit that subscribe button so you're notified every time we go live or post new content. We go live Monday nights on Facebook and YouTube, Tuesday on Instagram, and we post content daily on TikTok and Instagram. All right, guys, enjoy the night. We want to end all our episodes with our attitude is gratitude. And if you need to get a hold of us, give us a call, 714-790-9697, or email us info@whatsamortgage, or just message us. All right, guys, we want to end all our episodes with our attitude is gratitude. Without you, there would be no us. So thank you guys so much. Have a great night. Thank you, Mary. Thank you, Pal. Thank you, Zeph. Thank you, Cleopatra. Thank you, Mary. Mary's right there. Thank you, Tyler. And everyone else. If I didn't say your name, doesn't mean I'm not thankful for